If you are one of the 70 million Americans receiving a monthly check from the Social Security Administration, a single piece of mail arriving in a plain white envelope this week could instantly put 10% to 50% of your retirement income at risk. Just last week, I was sitting at my kitchen table with a stack of yellow legal pads, trying to help a neighbor make sense of an SSA letter that looked like it was written in a completely different language, full of dense legalese, acronyms, and vague threats of benefit suspension. She had been holding it for 3 days, afraid to open it all the way, not because she had done anything wrong, because she did not know what the letter was actually saying or what she was supposed to do about it. That feeling is more common than most people admit. Most people assume that a bad news letter from the SSA means they made an irreversible mistake, or that the government has already decided what happens next. What they do not realize is that the system depends on your silence. The bureaucracy runs on inaction. If you know the exact steps to take, and you take them inside a specific window of time, you can legally freeze the government's ability to touch your check while your case is reviewed. But before we talk about how to stop a collection in its tracks, we need to start with the most common letter that shows up on retirees' doorsteps every January, and the silent tax trap most married couples never see coming until it's too late. Every January, the Social Security Administration mails out a form called the SSA 1099. For most retirees, it arrives, gets filed with the tax paperwork, and gets handed off to an accountant or plugged into tax software without a second thought. That piece of paper is one of the most quietly damaging documents in your financial life, and most people do not understand why until they see the bill. Here is what is actually happening. The IRS does not tax your Social Security benefits in the same way it taxes a salary. Instead, it uses a separate calculation called your provisional income. That number is your adjusted gross income plus any tax-exempt interest you received, plus 50% of your annual Social Security benefits. Once that combined number crosses a certain threshold, the IRS has the legal right to tax up to 85% of your benefits. Think of it as a trigger line. The moment your provisional income crosses it, a portion of the money you spent decades paying into the system becomes taxable income all over again. For single filers, if your provisional income stays under $25,000, none of your benefits are taxable. Between $25,000 and $34,000, up to 50% becomes taxable. Once you cross $34,000, up to 85% is on the table. For married couples filing jointly, the line shifts. Under $32,000, you owe nothing. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, and you are in the same 85% exposure territory. Most married households with a pension, a part-time job, or required minimum distributions from a 401k sit comfortably above $44,000. So the 85% threshold is not a fringe case. For the majority of middle-class retirees, it is just the reality. Now here is the part that explains why this keeps happening year after year. These thresholds have never been adjusted for inflation, not once. They were set in 1983 for the 50% tier and 1993 for the 85% tier. A couple living on $44,000 in 1993 was doing quite well. Today, that same number barely covers housing and health care in most parts of the country. The thresholds stayed frozen while the cost of living kept climbing, which means more retirees get pulled into this tax territory every single year without doing anything differently. If your SSA 1099 shows a number that does not look right, maybe benefits you never actually received, or benefits from a year where fraud occurred on your account, do not file your taxes using the wrong figure. Call the SSA at 1-800-772-113 or go into your local office and request a corrected form. And if you find yourself consistently facing a large tax bill at year-end because of this, there is a simple fix. File Form W-4V with the SSA. That form lets you choose to have federal taxes withheld from your monthly benefit automatically at rates of 7%, 10%, 12%, or 22%. It does not reduce what you owe, but it keeps the bill from arriving as one large surprise. But what happens when the letter in your mailbox is not about taxes at all, but rather a demand for you to pay back tens of thousands of dollars they say they sent you by mistake? That is where most retirees panic, and that is where the SSA's 30-day clock starts ticking. An overpayment notice from the Social Security Administration is one of the most disorienting letters a retiree can receive. The envelope looks official. The language sounds final. And somewhere in the middle of the dense paragraphs, there is usually a number, sometimes $4,000, sometimes $12,000, sometimes more, followed by a demand to repay it. Most people's immediate reaction is to call the number on the letter, assume the government is right, and figure out how to pay it back. That instinct is understandable. It is also the one that costs people the most money. I'll admit, early in my career, I used to believe that once the SSA's automated system flagged an overpayment, the withholding process was essentially unstoppable, that retirees just had to absorb the blow while the math worked itself out over the following months. I was wrong. The law actually provides a powerful emergency brake that most agency staff will not volunteer to tell you about. When the SSA determines they paid you more than you were entitled to receive, they have the authority to recoup that money by reducing your future monthly benefits. Until 2024, they could withhold 100% of your monthly check to recover the balance. That policy changed in March 2024. The SSA now caps that default withholding at 10% of your monthly benefit, or $10, whichever is greater. On a $2,000 monthly check, that still means $200 gone every month until the balance is paid. For someone on a fixed income, $200 a month is a car payment. It is a utility bill. It can break a retirement budget that had no slack in it to begin with. Here is what changes everything. If you file either Form SSA 561 or Form SSA 632 within 30 days of the date printed on the notice, the SSA is legally required to freeze all collection and withholding efforts immediately while your appeal is under review. The withholding rate drops from 10% to 0 until a formal decision is made. That can take months. During that entire time, your full benefit continues arriving unchanged. The two forms serve different purposes, and knowing which one to file matters. Form SSA 561 is a request for reconsideration. You file this one when you believe the SSA's math is wrong, when you do not think you actually owe the money. Maybe they miscalculated your reported earnings from the previous year. Maybe they applied a payment to the wrong account. If you are disputing the underlying claim, SSA 561 is your form. Form SSA 632 is a waiver of overpayment recovery. You file this one when you agree the overpayment happened, but you believe it was not your fault, and repaying it would cause you real financial hardship, meaning you cannot cover your ordinary living expenses if the withholding proceeds. This is not an admission that you did something wrong. It is a formal request for the SSA to absorb the error rather than passing the cost on to you. Both forms are available for free on the SSA's website. Both trigger the same immediate legal freeze on collection. And both give you time, real time, to gather documents, consult with someone who knows the system, and make a deliberate decision instead of a panicked one. The 30-day window is not generous. If you receive a notice dated a Monday, the SSA considers the clock started 5 days after that date to account for mailing time. That gives you about 30 days from the day the envelope arrives. Write the date you received it on the envelope. Keep the envelope. it matters. While stopping an overpayment collection can protect your current income, there is another letter, sent specifically to surviving spouses, that contains a trap with no undo button. If you sign it without checking one number first, you could permanently reduce your lifetime income with no way to reverse it. Every year, surviving spouses across the country receive a letter from the Social Security Administration that looks, on the surface, like good news. The letter tells them they may be eligible to switch their benefit from the survivor benefit they have been receiving to their own retirement record. For many people who have just turned 70, the timing seems to make sense. Age 70 is when your own retirement benefit reaches its maximum. So switching at 70 sounds logical. It can also be one of the most expensive mistakes a surviving spouse ever makes. Look, I do not know every detail of your specific work history, your late spouse's earnings, or your family's exact financial situation. But I do know this. The SSA representatives who process these applications are evaluated on how many applications they handle, not on whether switching actually improves your lifetime income. You have to run the math yourself before you sign anything. Here is the trap. To even qualify for your own retirement benefit, you need 40 work credits, which generally means at least 10 years of covered employment. And even if you meet that requirement, your own benefit might still be lower than the survivor benefit you have been receiving for years. Consider this scenario. A woman we will call Sarah has been collecting $2,400 a month in survivor benefits based on her late husband's work record. At 70, she receives the letter suggesting she switch to her own retirement benefit. Because she spent 15 years out of the workforce raising her children, her own retirement benefit, even with the delayed retirement credits applied, comes to $1,900 a month. The moment she submits that application and it is processed, her survivor benefit is permanently terminated. There is no reversal. She has just locked in a $500 monthly reduction. That is $6,000 a year for the rest of her life. The prepared version of this same situation looks completely different. Sarah logs into ssa.gov, reviews her own estimated benefit, and sees that $1,900 figure before she ever responds to the letter. She keeps her $2,400 survivor benefit exactly as it is. She does nothing, and doing nothing in this case was the right financial decision. The SSA letter is not a recommendation. It is an invitation to apply. You are never required to act on it. If your survivor benefit is higher than your own retirement benefit would be, staying where you are is often the correct answer, and the agency will not tell you that directly. This fear of making a permanent mistake is exactly why so many retirees freeze when they get mail from the government. And nowhere is that fear more acute than for people receiving disability benefits, who live every day with 3 letters in the back of their mind: CDR. CDR stands for Continuing Disability Review. If you are receiving Social Security Disability Insurance, SSDI, before you reach your full retirement age, the SSA periodically reviews your case to confirm that your medical condition still meets their definition of disability. The letter arrives in your mailbox, and for many people, just seeing those 3 letters is enough to trigger a wave of anxiety. That anxiety is understandable. The fear is that the SSA will decide you have recovered, cut off your benefits, and leave you with no income and no plan. And because the stakes feel so high, many people respond by doing nothing, not returning the form, not updating their records, and hoping the letter quietly goes away. That is the single most dangerous thing you can do. Failing to respond to a CDR form is the #1 reason benefits are suspended, not medical recovery. The SSA does not terminate benefits because you did not get better. They suspend them because you did not respond. Now here is what most people on disability do not know about the review process itself. The SSA does not just look at whether your condition has changed. They also use what are called the medical vocational guidelines, sometimes referred to as the grid rules, to evaluate whether someone your age could realistically be expected to adapt to different work. And the older you are, the harder that standard is for them to meet. At 55, the rules shift in your favor. At 60, they shift further. If you have spent decades doing physically demanding work, the SSA cannot simply determine that you are capable of doing a desk job and cut your benefits on that basis. The law recognizes that retraining becomes harder as you age, and the agency has to account for that in their evaluation. So if a CDR letter arrives, the right response is not avoidance. It is documentation. Keep a continuous log of your medical appointments, your prescriptions, and your physician visits. The burden is on the SSA to demonstrate that your condition has improved since your last review. But you have to supply the medical records that show your condition is stable or worsening. Your file has to tell the story. If it does not, the agency fills in the gaps, and not in your favor. Navigating all of this does not require a law degree. It just requires a systematic approach. Let's go through the exact steps to put in place today so you are not caught off guard when the next letter arrives. There are 3 things you can do right now, before another letter arrives, that will give you far more control over every SSA interaction going forward. First, set up your account at ssa.go/login, or create your login if you have not done so. The SSA's online account lets you see notices the moment they are available, which means you are not losing days to postal delivery while your 30-day appeal window is already running. Electronic delivery also creates a clear timestamp on your end, which matters if timing ever becomes a dispute. Second, when any physical SSA letter arrives at your door, write the date you received it directly on the envelope, and keep the envelope. Do not just pull out the letter and recycle the packaging. The date printed on the notice is not necessarily the date you received it, and that difference can protect your rights if you ever need to demonstrate you acted within the appeal window. Third, if you are getting close to the provisional income thresholds we covered earlier, the $32,000 to $44,000 range for married couples, talk to a tax professional before the end of the year. There are legal strategies, like managing Roth conversions or being thoughtful about the timing of 401k withdrawals, that can keep your income below the line and reduce or eliminate the tax on your benefits entirely. The SSA sends millions of letters every year. Most of them are designed to be confusing enough that people either ignore them or comply without questioning. The ones who come out ahead are not the ones with the most money or the most connections. They are the ones who opened the envelope, understood what they were looking at, and knew what to do next. If this breakdown was helpful, hit subscribe. Here at Wes Investor, we do not just explain the rules. We show you how to navigate the system so you can keep every dollar of the retirement you earned. Let me know in the comments if you have received one of these letters recently, and let's keep the conversation going. I'll see you in the next video.